Good afternoon and welcome to Unlock the Stock. We are pleased this week to welcome the CA&S Group back to the platform, which is specifically designed for investors to gain access to corporate management and to get to know them and their companies better. Unlock the Stock is only possible with our technology partner, Lumi Global, so please visit their website, lumiglobal.com, to learn more about their various online AGM and investor presentation solutions. Our host today, as always, will be the finance ghost, Mark Tobin from Coffee Microcaps, and they'll be facilitating the Q&A session. This event is sponsored by A2X, a stock exchange that plays an integral part in the progression of South Africa's financial markets. A2X is the second largest stock exchange in Africa as measured by market cap, with 180 securities currently listed on the platform, including 30 top 40 stocks with a combined market cap of 10.4 trillion. The team at A2X are proud to be partnering with Unlock the Stock. Just as this platform unlocks value through insights and analysis, so too does A2X unlock value for the stocks listed on its platform, helping to drive the market forward. We'd like to welcome the CEO of CA&S, Duncan Lewis, back to our platform for this. But before we start, just a few housekeeping notes we'd like to run through. Duncan will take you through a presentation followed by the Q&A. Please note that you'll be able to post questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel soon. You will see an email address when we begin the Q&A, so if you'd like to be added to CA&S's distribution list, please send an email to that address. Duncan, if you could please share your screen and take us through your presentation.
Good afternoon, Deborah. Thank you. And good afternoon to your audience. Very good to be in your company, and thank you for your interest in our business. This afternoon, I'm just going to give first-time viewers a little bit about who we are and what we do, and then an update on our half-year results ending June of this year. And then I'm going to do a deeper dive into the segmental update in the various jurisdictions, and then an update on our journey towards 2026, and end with some questions. I'm going to just share a 1.5-minute video with you, which will give you an overview of the organization.
Welcome to the CA&S Group, a holding entity of a collective of retail solutions businesses operating across Southern Africa, providing essential services delivered by essential workers to ensure millions of households get the essential products they need to experience better quality lives. CA&S offers route-to-market services to top-tier multinational and local brand owners and manufacturers. Group services include warehousing and distribution, retail execution, retail support services, data and technology services, and retail partnership and training. We believe that the rapidly changing world we operate in offers immense growth opportunities.
We believe in the exponential power of true partnership to unlock the potential for our clients, for our people and their communities, for our businesses and shareholders.
So, if we talk about who we are and what we do, essentially what our job is to provide on-shelf availability of the world's best loved brands. So we're in a very fortunate position where we represent the top 200 or 220 consumer brands in the world. And it's our job to make sure that it's our job to ensure that those products can be shopped by consumers in the 8 geographies where we have a presence. Next. We talk about being a purpose-led business. As you all know, is our business is made up of route-to-market solutions providers in these geographies. And each one of these businesses is market-leading in that respective geography. But we talk about the power of and that is really around sharing and collaborating and involving better quality client solutions. So we really think that we are client-centric, and through this collaboration with our client and with the individual business in these geographies, we're able to evolve better quality solutions. Next, Andre. So the way I would describe it is our business is really around providing essential services delivered by essential workers to ensure millions of households get essential products they need to experience better quality lives. And, this was brought home to me during COVID, where we were declared an essential service, and we were able to ensure that products got to store in these geographies, and shoppers and consumers could get the goods that they needed. And I think it's testament to the people that we employ. Those are the ones that compromised themselves. They got up at 4 o'clock in the morning to ensure that they packed the trucks, got the goods to store, and executed in these retail environments. Next, please, Andre. We talk about the three growth pillars, and I think that our business is built on three things. Firstly, it's around capability building, and capability building for me is ensuring that we have the right people in place, and these right people equipped with the right tools and skills to get the job done. The outcome is that they're able to deliver operational excellence for the clients. So we have world-leading brands, they have high standards, and we're only able to execute on these high standards if we have capable people equipped with the right tools in the store. So if we've got capable people delivering operational excellence, the accelerated growth that we seek as an organization will come as a consequence of doing these other two well. Next. We talk about values and guiding principles. I'm just going to single out three. So you heard me talk about distinguished delivery. That's essentially the operational excellence I talk about. But the next thing is around people partnerships. And people partnerships is with the partnerships with our clients, obviously, but also with our people and the respective businesses. And through this power of partnership that we believe, this creates an emotional bond between our people and the business, and our people and the brands that they represent. And that's where the magic happens, in my view. The other thing I want to talk about is entrepreneurial hearts, is that we're very much an entrepreneurial driven business. We have motivated self-starters in place, and that is very much the culture of the organization around being agile, customer-centric, and ensuring that we remain future fit. Next. This slide is an overview of the geographies where we have what I would describe full service offerings. And these are the businesses that we operate in these respective geographies. So if we could single out Namibia, for example, we run a business called SMC Brands, Thabo and Corson, Wuto Trading, Mac Mobile, and Visible Works. There is an exception to this in the sense that we operate in a further 16 countries, but that is with our mobile technology platform via Mac Mobile. Next, Andre. What this slide is meant to depict are the four generic services we have. So we talk about warehousing and distribution. We talk about retail execution and advisory, retail support, training, technology, and data solutions. From a revenue contribution point of view, is 80% of our revenue comes from warehousing and distribution, 15% from retail execution and advisory, and then 5% from the rest. One could argue is that why have it if it's only 5% of the total revenue? I think that it is those services there that enable us to be better as a business. It is those services that improve the DNA of the organization. So we use those platforms to highlight, inefficiencies in the business, white spaces and opportunities. And also we use those platforms to provide clients with greater insights and value. So it is those data platforms that we leverage to bring, the marketplace to our clients and show them the opportunities in these respective retail environments. Next, please, Andre. This is an overview of the economic indicators, and I'm sure that you see these every day, but I just wanted to talk about two, and that is if one talks about food inflation. Food inflation, peaked probably in December last year, and we're seeing, food inflation at about 11% year-to-date June. Our view is that, if one looks at the conversations we're having with clients, and we look at potential price increases down the line, we believe that food inflation has peaked, and we're seeing a slow tapering off. But if you look at real retail trade sales, there's definitely been a contraction for 7 months consecutively in retail trade sales. However, not grocery. This is total retail trade, including furniture, clothing, et al. We still think that there is value growth in the grocery sector, although volumes, I would argue, are flat year-to-date June. Andre? This slide is really just the highlights of our half year for year-to-date June. We talk about revenue. Revenue increased on the previous year of 22.5% to 5.2 billion. EBITDA, sorry, that's just coming on my screen, just bear with me. EBITDA up 66.4% to 436.6 million. We'll unpack that just now in greater detail. If you look at operating profit, up 75.5% to 387 million. That too we'll unpack in granular detail just now. Headline earnings up 24.8% to 172.7 million. Headline earnings up 21.5% to 36.5 cents. And then finally, net asset value per share up 26.1%. I'm going to hand you over to my colleague in finance, Rech, who's the CFO of the group, to take you through the next few slides in greater detail. Frans.
Thank you, Duncan. Good afternoon, everybody. Yes, this slide just depicts the revenue number, the 5.2 billion that was generated the first 6 months of this year, up 22.5% from the previous 6 months last year. The 22.5% growth we split between organic growth and acquisitive growth. Organic growth is 16.4%, and the rest was the acquisitive growth that was incurred in this first 6 months. Andre, in the next next slide, please. This is just a graph to show that the movement of headline earnings from revenue, to show that the top line is driving the bottom line, with nice growth of also 21% in headline earnings per share of 36.5 cents. Next slide. This is just a slide to show the main line items on the income statement. Revenue 5.2 billion versus the 4.2 billion of previous 6 months, and adjusted EBITDA of 312 million versus 262 million, which is up about 19%. Now, Duncan said in the previous highlights in the previous slide of EBITDA that's up about 75%. Now, what happened is we had this one abnormal item with the acquisition of Tobin and Keyter, which was a Namibia business, where we realized a bargain purchase of about 123.5 million. That relates basically mostly to the property portfolio that was included in that transaction, and therefore the high increase, but normalized in line with a revenue growth of about 20%. Next slide, please, Andre. This is the balance sheet, a quite nice, if you see the net non-current assets on the top, a movement of about 100 million. That relates to the property portion of the Tobin acquisition, which is an abnormal from the normal growth. The normal current assets up in line with revenue growth. We are quite heavily invested in working capital, and therefore the increase in current assets. The net cash position as at the end of June was 206 million for the 6 months. Next slide, Andre. This is just the working capital, just to break it up for you. Inventory, 31 days, trade and other receivables, 55 days, and trade and other payables, 51 days, giving us a net cash conversion of 35 days for the 6 months. A little bit higher than the previous 6 months, but in line with growth and acquisition. Usually with acquisitions and restructuring, there are some items that need to be cleaned and sorted out and get everything in line again. Next slide, Andre. Then the cash flow, nice cash flow generation of 260 million for the 6 months, in line with previous 6 months. Working capital, nice inflow of 112 million. A significant portion of that relates to the Tobin transaction, where some debtors working capital has been converted into cash. And then other line item is debt investments, which is this outflow of 62 million. That relates basically to the Tobin acquisition, Market Max in South Africa, and our increase in a small little business in Swaziland called Takpro. And yeah, that's I think a very nice 6 months from our side. Thanks, Duncan. Andre, you can move to the next slide.
Thank you, Andre. So this is just an overview of the group. And so if one looks at the middle of the tile, you'll see the growth by jurisdiction. So if you take Botswana, growing at 15.1% to 2.65 billion. Eswatini also growing by 15.3% to, excuse me, 769 million. Namibia growing at 62.4% over the previous period to just over 1 billion. South Africa, revenue growth of 9.5% to 720. And then all the other countries, which is Zambia, Zimbabwe, and Lesotho, growing at over 100% to 93 million, admittedly off a fairly low base. I think that if one looks at the pie graph, what's interesting for me is, you know, our business is very heavily weighted towards Botswana, and in the previous period, 55% of our revenue came from that jurisdiction. Because of the growth out of Namibia and the other territories, we're now seeing a reduction in that, and a better split starting to develop between Botswana and the other jurisdictions. We're still expecting, you know, significant growth out of Namibia and the like, and we think that over time, you know, we'll have a far more even split across the jurisdictions. Next. You know, I think that despite what I'm saying around 50% of revenue coming from Botswana, we still see it very much as an invest-to-grow market. You know, we've added clients in both the retail and wholesale sector. We continue to develop our new business pipeline. You know, I think that there remain opportunities in this jurisdiction for channel broadening, you know, whether it is hardware, whether it is pharmacy and the like, those remain opportunities. Next, Andre. If you take Swaziland, you heard me talk about the revenue growth. I think that we're very pleased with the growth in EBITDA and EBIT. EBIT up to 62.89 million. That's an increase of 56.8%. We've spent the last 2.5 years investing heavily in capability building, people, technology, systems, processes, and I think this is the reward for it. Next. If you take South Africa, I think South Africa revenue growth of 9.5%. I think well below the average, but I think that we have been in a building phase in this business. We did an acquisition late last year of Effective Sales and Merchandising, and more recently Market Max. I think that this business has just taken on over 800 people, and then we've been awarded new business in the liquor space, effective the 1st of October. They've been awarded level 1B status, and we've just done a learnership program. We just had over 500 graduates, and I think that like we've seen the rewards in Eswatini, I think we'll see the same in South Africa going forward. Andre? Namibia is the interesting one with the 62% revenue growth. I think that in the context of Namibia, by revenue, our business there would be what we would describe as the number 2 player. I would say the number 1 player does at least probably as much as 3 times the revenue that we do. So despite the 60% revenue growth, we still see lots of runway in this business. So therefore we continue our invest to grow mindset. We are developing our new business pipeline, and I'm fairly optimistic that the revenue growth we'll see continuing and closing the gap between number 2 and number 1. Andre? If you take all the other geographies, as I said, growing at over 100%, admittedly off a small base. I think that these geographies have different stories. So in Lesotho, it's fairly onerous regulatory environment, and so we've had to navigate trading licenses, liquor trading licenses, and so fortunately we have that all in place. We have commissioned our physical infrastructure in the form of DCs, etc., and we're starting to be rewarded for that. We developing our new business pipeline. We've started with 3 new clients there, and I think that we'll see some nice growth come out of Lesotho. Zimbabwe, have continued our expansion in Zimbabwe, but I think that we manage the growth in that business fairly carefully, and it's a complex environment to navigate. And so whilst there are lots of opportunities, we want to make sure that we develop those opportunities within a very firm framework. Taking Zambia, Zambia for us is a high potential market. We've been in Zambia for close to 2 decades, and we've made a decision to expand rapidly in Zambia, and ensuring that we have a credible solution in place. As some of you may know, is that by and large we have a client-led growth strategy, and we'll see some momentum build quite quickly out of our Zambian business. And I think that is accelerated by things like a growing, modern trade. So the split between, if I can call it the informal trade and modern trade, is probably an 85-15 split. But the modern trade is growing rapidly, I think accelerated by things like rapid urbanization, a growing middle class, etc., etc. So we see those factors as a catalyst for accelerated growth. Andre? So the next one, please, Andre. For those of you who've heard us talk before, back one, I'm sorry, sir. For those of you have heard us talk before, we have a dream, and the dream is to create a 20 billion rand business. That means doubling the business between now and 2026. You know, I think that what I wanted to say is, whilst this isn't easy, you know, the team are restless. They have a pebble in their shoe. This is certainly possible. You know, what I can say is that the rollout is firmly on track. From a revenue growth point of view, we've set ourselves a target of a compound average growth of 20%, and we're on track. So if you go to the next slide, please, Andre. If you just you know, look at this slide here, whilst we talk about revenue growth, frankly, the revenue growth is a proxy for everything else, and that is around sustainability and profitability. So if you look at the net margin in 19, it was 2.9%, 20, 2.9%, and then slowly expanding in 21 and 22. You know, you heard me talk about the revenue split between warehousing and between warehousing and distribution and the so-called retail services. We're expanding the contribution from the retail services, which are you know, traditionally margin richer, and we've got the blend between the two, and that should drag up the margin for us. And that's what we're aiming to continue to do. If you look at the half year 23, you know, you'll see the net margin there of north of 5%. Andre? So, you know, I think that a combination of organic and acquisitive growth will get us to the 20 billion. If you look at the current run rate, you know, I think that we're comfortably on track to achieve probably north of 18 billion in our current space. We're working hard on acquisitions that we deem appropriate and can complement the existing business. And I think the combination of the two will get us to the revenue ambition of 20 billion, as I spoke of. Andre, next. This is really just the building blocks, and you know, I think all that needs to be said is that we're on track, and we're fairly comfortable for now. If we remain restless and focused, we believe we can achieve the 20 billion, as I've said. Next. Just with regards to the main objectives for the next 3 years, you know, I think that I don't want to go through all of them just because of time, but I think that the important thing for me is to continue our digitization journey, and that is both an internal and external focus. We're working very, very hard to make sure that we digitize the business and remain future fit. The other thing is, you know, making sure that we continue to deliver operational excellence for our clients, making sure that we're using these periods to grow their market shares, growing their depth of distribution, and making sure that we remain focused around achieving those objectives. And then the other one is continuing to make sure that we're delivering a compound average growth rate of 20% or more. And in the process, continuing to be dependable, reliable, and stable for our existing clients. Next. So what I can say is that, you know, our developing of our new business pipeline remains firmly on track. These other acquisitions and complementary services I spoke on earlier are designed around providing greater value for our customers and making sure that we're providing them with insights and that we're able to execute on those insights in these respective geographies. And, you know, I think in this is around making sure that we continue to collaborate internally, externally, with both retailers and with brand owners to make sure that we fulfill the potential that exists. So thank you, Andre. That's it, sir.
Thanks very much, Duncan. And we're going into the Q&A session now, which you should be familiar with if you've joined us before, which is facilitated by the finance gurus and Mark Tobin. And as a reminder, just please type your questions into the Q&A box at the bottom of your screen. And over to you and Mark and the finance ghost.
Thanks, Deborah, and thanks to Duncan and all the CA&S team for joining us once again here on Unlock the Stock. Duncan, maybe if I know you touched on some of the macro indicators in your presentation. Maybe if we can just dive into that just a little bit more. I mean, from us looking the outside, we've seen various retailers report somewhat confusing results. Pick n Pay, very bad. ShopRite, excellent. Then we look at, the big real estate guys and, they talk, trading densities up, footfall up, but yet we hear retailers like very, mixed depending on parts of the country and sections you're in. Maybe on a broader level, what are you seeing in terms of from the brands that you work with, or even verticals that seem to be, weathering this high interest rate, high inflation environment storm well, whether that's hardware, liquor, FMCG, food, maybe just give us a sense of, if you look across the broad spectrum of everybody, who seems to be kind of doing better than others, if I can say that.
Yeah, Mark, I'm going to start with an apology because in the transition it cut me off, so I had to dial in again. So I missed the first part of your question. So I'm sorry to do this to you, but would you mind repeating it? I'm sorry, sir.
No, it's no problem. I was just going to say, from us looking at from the outside, we see very mixed results in the retail space. Some of the retailers like Pick n Pay, not growing great. ShopRite maybe shooting the lights out. Then we see the big REIT guys and the JSE saying, trading density is up, footfall is going nicely. I was just wondering, in terms of the brands that you work with, can you just give us an overview of who seems to be kind of doing well, whether that's FMCG or liquor or apparel or, food and beverage more kind of broadly. Just, it's kind of on that slide you had with, the macro indicators. Just maybe give us a bit more little insight of the, if you look across the spectrum of the brands that you work with, where seems to be some of the bright spots and, where seems to be kind of some of the places that are lagging.
Yeah, so, I think that what's telling for me is volume, Mark. So, if I can start there. So, year-to-date June, volumes were flat. Interestingly enough, if one looks at July and August, we're seeing volumes grow, which is, for me, very encouraging. But, I think that no two geographies are the same and no two categories are the same. So look at our categories. We do personal care, home care, snacking, treating, food, etc., etc. So if you look at the liquor space, across the board, across the 8 geographies, there's no doubt that the liquor sales have been under pressure. In the context of that, there's been winners and losers. So, shifts, etc., etc. But liquor generally has been under pressure. And, I think that the turning point for us was probably around November last year, where we saw the handbrake come up. And so, as I say, there are winners and losers within the context of that, but liquor has been under pressure. And there's certainly a shifting in consumer behavior around categories. So, shifting from more expensive stuff to cheaper stuff, etc., etc. But if you look at personal care and home care, snacking and treating, those categories for us remain very robust. So I think that, people certainly in some cases would trade down in categories. And, we're certainly seeing a shift in some cases to private label brands. So if you look at the guys ShopRite, for example, about 20% of the basket would be made up of private label brands. But categories as a whole, personal care, home care, snacking and treating continue to get volume growth out of those categories.
Okay, perfect.
Thanks, Duncan, for your time today. You'll have to excuse me. I'm in a coffee shop this time, which I never do, but it's just the way this day planned out for me. So I'm sorry if there's any background noise. I'll try to just speak less and there'll be less noise. Just a question around, I suppose, inflation and product categories and all that kind of thing, because that's really important for people to understand. And it very much looks like you still have a growth path ahead of you that is not just about pricing, because that's what happens with obviously very large retailers, is volume growth kind of simmers down and pricing becomes a big part of the story. So when there's inflation, that's very helpful. I think you still obviously have a lot of volume growth ahead of you, but maybe something I want to understand is, what does the margin mix look like in your world? So for example, when a product category makes better margin for a retailer, does that make it better margin for you as well? Or do you kind of make similar margins almost irrespective of the categories that are growing or maybe not doing so well?
Yeah. So, I think that whilst the retailer in our case is a very important stakeholder, the retailer doesn't pay our bills. It is the brand owner. So we're executing in these environments on behalf of the brand owner. So Ghost, we don't make a margin on the stock. The brand owner and the retailer will decide on what an RSP is. My fee is determined as a percentage or a fixed fee on that RSP. So in other words, I sell something for 10 Rand and I earn a 10% fee. And so I make a margin on the service that I provide for that particular client. And fees vary depending on geographies, cost of distribution, categories, etc., etc. And then obviously dependent on the services that we provide for that particular brand owner.
Duncan, I know you said that, the 2026 20 billion target, is going to be a mix of organic growth and acquisitions. If we just look at the acquisitions, because you did mention as well, is there a possibility of kind of killing two birds with one stone here? When I look at the map of the countries you operate in, Mozambique is an hospital absentee, and maybe if we go a little bit further afield, even Mauritius. But is there a possibility of doing an acquisition that gets you into the Mozambique market? So it's a new geography and an acquisition that adds volume into the mix, and then just given you're in Botswana and Zambia and South Africa, it enhances the network effect of distribution by having some kind of presence in let's say Mozambique.
So that's ideal for us, Mark. So where we find a credible operator in country that is either a number one or number two player, where we have clients in common, and where we believe that, through our joint efforts, we can get accelerated growth. Those are few and far between. We have done those before, and they've been very, very successful for us. And we continue to look for acquisitions like that in priority markets. So if you talk about Zambia, Mozambique, and Mauritius, I think that my bias would be towards Zambia and Mauritius, but we're on the lookout for those types of acquisitions, sir.
Quite funny because I just got a comment in my DM saying, please come to Mauritius. And I quote, when we shop here, it's like a treasure hunt. So there we go, Duncan. There's a treasure hunt that you can go and solve for people in Mauritius. Just talking about acquisitions, I've got a separate question here, just about the TNC Group. And I guess maybe the way you might think about buying, a loss-making or underperforming business. What does that turnaround strategy typically look like? Do they, is it an operational level turnaround? Do they need to kind of be assimilated into your broader group? Just commentary on that.
Yeah, so I think that this acquisition is very much an exception to the rule for us. We have observed the business for a long time. We understand the ways of working, and I just think that in our hands, I think it, frankly, a better fit. So this is all about operations, and I just think that we know how to run these type of businesses in these geographies, and so it's taking a capability and implementing it in that business, and making sure that one is very focused around the objective one is trying to do, and making sure you follow through. So in these processes, there are tough calls to make around some clients, people, relationships, etc., etc. And there's some tough calls to make. But I think that I think that we understand these type of businesses, so we don't target the distressed businesses. But I think this is one that we understood what we needed to do.
Duncan, just another one in terms of that 2026 goal. In terms of what that takes from an investment standpoint, obviously there's a working capital uplift that's going to happen as you naturally grow the revenue line. But I'm thinking of more, what kind of costs would need to support that in terms of a major ERP upgrade of like your systems, or major warehouse expansion, big heavy CapEx type projects that will go with supporting that level. And I know you can have acquisitions and that can bring a long warehouse space that's already in play, but maybe just talk to us about what additional kind of investments would need to be made from your side in order to support the 2026 20 billion rand dream.
Yeah, so the obvious ones around working capital. But I think the importance for me is around making sure that we continue to have a firm foundation, and chief among that, from an operational standpoint, would be the right people with the right skills. And we spend a lot of money on developing existing staff, but also making sure that we are developing the leadership pipeline of tomorrow, because the quality and sustainability of our business is around the quality of the people. We cannot compete with the multinationals for skills, so therefore we have to develop the skills internally, and we're very focused on making sure that we're evolving skills and developing people. From a technology standpoint, you'll see, well, you may not, but we have across all the distribution businesses, we've standardized the ERP systems, we've standardized inventory, warehouse systems, and making sure that we, in this digitization journey, that we continue to evolve and continue to evolve rapidly. And so, of course, making a margin is important, but the truth is that right now we're in the building phase, and so ensuring that we are investing ahead of the curve. And if you look at the pack, the South African business, Pack and Stack specifically, you'll see that we're investing in future capability. Unfortunately, the profit's not what we want it to be ideally, but the fact is, if we don't do it, we'll be caught out, and we'll be rewarded for it if we do.
Duncan, I have a very interesting question in my DMs, so I'm going to hit you with it. I think it's quite left field, but that's why we do unlock the stock. So yes, the question is that the founding family in Botswana, this is going way back in history now, are they still involved at all in the operations, either directly or via property leases? And the reason for the question is, does this then create any kind of political risk around the business in Botswana as such an important segment? I told you it's a hard question and a left field one, but that's the question.
Yeah, so, if you talk about Botswana and any one of our geographies for that matter, we're already in the second generation of leadership, and all the businesses have transitioned to professional management. So, the founders, whilst may be involved in the businesses, in those respective businesses, specifically CA Sales in Botswana or Logico in Swaziland, the founding members of CA Sales, I think the ones, I think he immigrated to Australia, if I remember correctly. And the other one, I think, remains a shareholder in the listed entity. Is that correct, Franz?
He bought separately.
That he bought separately,
Yeah,
right? Yeah, but not involved at all in the business.
Duncan, just another one. I just want to talk about the impact of weakening exchange rates, right across your business, whether we're talking the rand, we're talking Botswana pula, with just the strength of the US dollar across all of these currencies, is that impacting as you say, like volumes and I guess the ability for, I guess distributors to actually, keep supplying the products into these markets. I'm thinking of it's a very small example, but the Hellmann's mayonnaise one, where they like the distributor in South Africa says, no, we're going to discontinue it because it's like not profitable to bring it in at like these prices. But then, Pick n Pay, I think very cleverly stepped into the gap and I think are the sole distributor now. You can only get it from a Pick n Pay outlet. But, maybe just how this strong dollar is like impacting, especially the imported stuff, whether it's from, Procter & Gamble, Nestle, Unilever, Coke, any Pepsi, any of those guys. Is it really starting to bite that you can see?
I think that if you go back to the period of 2021 when we had COVID, Mark, I think service levels were severely impacted around the world. We saw the price of containers increase dramatically, and that was a tough time for many people. And I think that if one looks at post-COVID, and you heard me talk about static volume growth, there's no doubt that margins are under pressure everywhere. And we're seeing brand owners take a hard look at around what ranges are appropriate for their respective businesses. And I think generally speaking, we are seeing range rationalization around all brand owners and saying, based on the customer data, the better quality insights we're getting, what is appropriate and what are our must-win battles. So I think they're prioritizing what they bring to market, where they're focusing their energy and spend, and we're seeing definitely ranges, generally speaking, reduced.
So they're like different flavors, different variations of things are cut down. It's like the tried and true products that kind of people are well aware of, but the more kind of obscure names in the range are being quietly shifted to the side.
Yes, and therein presents opportunities for other people that want to focus on a range that perhaps doesn't appeal to the mainstream, but there still makes commercial sense, and we're seeing those opportunities develop, and people are taking advantage of those opportunities.
Indeed, it frees up shelf space for something else.
Duncan, I have a balance sheet question. I know you've got France back there, and I feel bad he hasn't been too involved in this, but maybe he'll take it anyway. We've seen no shortage of South African businesses, and it's very debatable whether you are a South African business in that form, but you've kind of been born in Africa. We've seen no shortage of businesses really losing their shirts with balance sheet stuff in Africa. Nampak, perfect example. What is different about you from a treasury perspective? Is there a risk there?
The short answer is no, but I think that let me hand over to France, and then I will pick it up once he's done, if you don't mind, please.
Thank you, guys. Basically, we are trading most of our regions. There's no treasury risk. Exchange rate at this time. The only one that we have as exchange rate risk is Botswana, but most of our sales and buying is done in rand to rand. So that it creates almost like a timely. It's just a time issue with our forex gains and losses that we have on our income statement. Actually, at this stage, the only ones that's now starting to come up is the Zambia market that we are entering. So there is a little bit of exposure, but most of that we try to mitigate through the pricing of the products, build it into the price of the products with the brand owners. But otherwise, we don't have any risk at this stage for getting any money out of any country which we operate in, except of course our friends Zimbabwe, which we have which is a challenging environment. But our investment there is minimal, but we don't have any issues on the treasury side.
Ghost, is there something you want me to expand on as far as that's concerned?
I think it's okay. It's just touching on, if there's more questions come through in the DMs around that, we can jump on it. I think we want to cover a broad range of topics. I'm conscious we don't have a lot of time left. Mark, how are your questions looking?
Yeah, I've got one for Franz as well, since he's on a roll here. Just on the tax rate, Franz, I noticed there was quite a decent drop in the effective tax rate. Is that due to changing mix of where you're earning profits, or is it related to the the T&C, like one-off gain? Is there something complicated to that? Because it did seem to go to come off a nice bit, and I'm just wondering, is that one-off in this year, or is it kind of more sustainable moving forward?
Mark, I mean, we look at a rate of around 26-27% for tax. The problem is that we operate in Botswana, and the Botswana normal company tax rate is 22%. So that brings it out quite significant, and a lot of profits generated there. And also back and stack, the South Africa business also generates a significant amount of profits, which is via a higher tax rate of about 28%, 27.5%. And Namibia, Namibia has a T&C transaction has effect. There's some tax losses that we can utilize there, but we haven't utilized that at this stage in that part of the world near Mark. But yeah, 26-27 is more average rate for this, and also that affects our tax rate. The first 6 months is the dividend withholding taxes that we had to pay for the money that we brought out of the different regions like Eswatini and Botswana, which actually increases the tax rate. And this side we are lucky to just decrease it. But also just remember, this 123 million on the T&C transaction has a big effect on the tax rate for the 6 months.
Okay, so people are trying to think about, trying to build a little model or whatever. They should go in that kind of 26 to 28 range as a kind of as a normalized guide. I'd say that.
Correct, Mark.
I've got only one question left in my DMs, and then I don't know how we're doing for time, but I think we're nearly done. It's quite an interesting one, and it's a bit of a history lesson. The name CA Sales has been around since the 1990s. What did CA originally stand for? Was it a bunch of chartered accountants running around selling bread? I'm sure it wasn't. I don't know if you guys know offhand, but I suppose, I've actually looked at the name before and wondered, what that is.
It's a history.
I think that whilst I don't know what the founders had in mind, but if you look at CA&S, for us, we talk about collaboration, activation, and sales. So it's about collaborating with the stakeholders, retailers, brand owners, and our business is an operational implementation one. And so we activate in these stores, and then, if we do the collaboration and the activation correctly, it should manifest in sales. So that's what the CA&S is about.
I like it. Thanks, guys.
Before Deborah jumps back in here to wrap up, I'm going to squeeze one more in if I can with Duncan. In terms of your business, how much do you factor in winning new brand distribution rights? So, let's say a competitor in whatever market, whether we're talking Bots or SA or Namibia, suddenly, not suddenly, but, Coca-Cola make a decision that they're, going to move away from them for whatever reason, whether it's price, service levels, whatever it might be. I mean, how much of that, winning new distribution rights goes into, the expansion plans for CA&S, and how often does that happen? Is it something that really, if somebody's got a long-standing relationship with, Unilever for personal care, like how often does that actually change hands in terms of contract and service?
Yeah. So you heard me talk about, we have a client-led growth strategy for the most part. So, our clients have identified priority markets, and, I think this relates to the Ghost's earlier question. Just because our client considers it a priority market doesn't mean we would prioritize it. So, I think that we are very conservative by nature. And so we're worried about certain issues, where there are sovereign risk around liquidity and getting paid out of that particular geography. We would certainly prioritize that. So the sweet spot for us would be geographies that we have prioritized, where a client wants to expand in, and that's the sweet spot that we would focus on. So, if you look at our business, and you heard me talk about the 20 billion, the opportunities for us to expand with existing clients in existing geographies is about a 3 billion rand opportunity. So, I think that the average client has been with us for 18 years, and clients don't generally, if they have a credible in-country service provider, we got to really work hard to take that business away from an existing service provider. If they're not credible and they're not doing a good job, obviously that makes it much easier. But the fact remains is we have a 3 billion rand opportunity in existing geographies with existing clients.
Perfect. Yeah, I was imagining the scale you're operating and competitors are operating. Those opportunities for taking over a specific brand distribution platform from a competitor would be few and far between. I think the 18-year customer average lifespan, I guess, kind of speaks to that. Deborah, do you want to wrap up for us, please?
I do indeed. And on that quite positive note, I'd like to thank firstly Duncan and Frans for being around. It's not been without its challenges today. Thanks for making time again to support this platform. I know you guys are broadcasting from a venue which has had some internet issues. Likewise, the finance goes from a coffee shop somewhere in Cape Town, but we've made it through, and we really have enjoyed the session as always with CA&S guys. And if you'd like to listen to it again, obviously, it will be on the Unlock the Stock YouTube channel soon, and we encourage you to subscribe to that for our latest videos. And of course, all that remains to say is to join us for the next Unlock the Stock event on Thursday, the 19th of October, and that will be featuring Calgro M3, which will also be returning to this platform. So please look out for the invitation. And that's me. Thanks very much indeed.
Thank you, Deborah.
Thank you, Deborah, and thanks to your audience. Have a good day, everybody.
Thanks, everyone.